climbs rapidly, but you are in the right place. This is the Sustainable Debt Global State of the Market 2020 report launch. Okay. Hello, everyone who is keen on creating a future fit for our children, a sustainable future. You've come to the right place. We are here today launching the Sustainable Debt Global State of the Market 2020 report. This is a substantial, major report. You will be able to get it from the Climate Bonds website, or you'll be able to get it in the chat function of this webinar if you wait long enough. We are kindly supported, fantastically supported in the production of this report by State Street Global Advisors and Decker Asset Management Decker Investment, I should say, in Germany, who have been, I'm going to say, fantastic supporters of this whole market with their investment strategies and their ongoing commitment to growth of the market. Today, we are lucky enough to have a collection of 5 panelists who are going to be with us. We will hear a little later from Rupert Cadbury from State Street Global, Ingo Speich from Decker, Parosh Hutasarion, who's from the Public Debt Management Office of Thailand, and Bernard Windisch, who's the European Commission. And Krista Tukianen first will speak about the report. She's the head of research and reporting at the Climate Bonds Initiative. I'm Sean Kidney. I'm the CEO of the Climate Bonds Initiative, and really lucky, thrilled to be here to talk about what an extraordinary year it's been. We started off the year with some shocks. First, wildfires in Australia and California. We thought that was going to be the worst to come. In the end, we experienced what can only be called a brutal pandemic that continues to be brutal around the world. A friend of mine, the eminent economist Rathin Roy in India, has just been admitted to the ICU in Delhi with COVID. And our thoughts are with you, Rathin. I hope you get better soon. We need you to create a more sustainable planet. This disease is still raging. Of course, this disease is not unrelated to climate change. The IPCC, Intergovernmental Panel on Climate Change, has been saying for 30 years, or the health committee of that IPCC, for 30 years that pandemics can be, should be expected as a feature of substantial climate change. The more catastrophic the climate change, frankly, the more chance of pandemics. As ecosystems degrade, as species have to cram into different corners of the ecosystem, and this particular pandemic as a result of pathogens jumping between species of bat colonies, we believe, in Southeast Asia and southern China, where their habitats have been destroyed and they've had to relocate. This is what the future could look like if we don't address it very quickly. Regular pandemics, regular wildfires, regular floods, like the massive floods in Bangladesh last year, and so on. So we're on a race. At the Biden Climate Summit a few days ago, we had fantastic, impressive commitments by a variety of countries for not only 2050 net zero targets, but for substantial decreases in emission by 2030, which is what the IPCC called for in 2018. Don't get me wrong, they're not all as ambitious as they need to be yet, but they are extraordinarily significant increases in ambition from 2019. This is while we've had the pandemic. We have largely, globally, chosen not to rebuild the past, but instead to focus on how we build back better, how we build a future fit for our children. The sustainable bonds market is just part of that story. We have about $90 trillion, according to New Climate Economy, that we have to invest in low carbon and climate resilient solutions. Adaptation is an important part of what we have to do, by the way, between now and 2050. Luckily, we have capital. We have about $100 trillion just in the hands of institutional investors around the world. Large parts of that capital are invested in zero or negative interest rates bonds. We will need to see the development of investable opportunities that can support the paying of my pension and your pension and insurance funds and so on going forward. We need to restart our economies. We can do it green. We can do it sustainable. Last week also, the day before the Biden summit, we saw the release of the Act of the European Taxonomy, linked with the launch of the more European Sustainable Finance Plan measures, and of course, the confirmation of the European 2030 target. On the same day that Europe released its taxonomy of green and sustainable investments, the Chinese central bank released or confirmed that the consultation period for its taxonomy was over and it came into force as well. They did that deliberately because they want to be seen as working, as Europe does, in concert to drive sustainable finance around the world. And that's really what we're now starting to do. This report, however, looks at last year, the brutal pandemic year. What happened? How we survived? How did we go on this particular measure, which is not an end game of sustainable bonds, but it's a piece of the puzzle. Krista, over to you now to present some highlights of the report. If you want to ask questions, there's a Q&A button. You can ask on that. This session will be recorded. You'll be able to get it later from our website, climatebonds.net, or from YouTube channel. Over to you, Krista.
Thank you, Sean. On my behalf as well, thank you everybody for joining us in this session today. My name is indeed Krista Tukiainen. I am the Head of Market Intelligence Research here at Climate Bonds Initiative. Before we get going, Sean's already introduced our fellow panelists for the day, but I just wanted to say another thank you to our sponsors, SSGA and DekaBank, who have supported us in putting together this analysis, enabling us to continue this pioneering State of the Market series, which is now in its 10th iteration. So we've been doing this for a while. I think our webinar team's already mentioned this in the chat, but the lead authors who have all the details about this analysis and generally where the market stands at the moment are manning the chat today. So if you do have questions for them or for us panelists, do note them down in the chat and we'll try and address them as best as we can throughout the session. I will go through some of the highlights in this report, but I'll try and do that really quickly because in the interest of time, we want to get to the actual panel discussion, which I promise will be quite illuminating based on our sort of preceding discussions to date. So to begin with, as Sean said, this market, the green, social and sustainability bond market has been quite small. It's been in its infancy for a long time compared to the overall vanilla bond market. However, we're quite pleased to report that at the end of last year, we did reach USD 1.7 trillion in green, social and sustainability debt instruments. 700 billion of this, or about 40%, was issued last year only. This is a huge, huge increase, as you can see, over time in terms of comparison to the preceding year, which landed at about 358 billion US dollars. We've seen almost 10,000 instruments being issued under these various themes over the last decade or so. And again, lots and lots of new instruments and new issuers came to this market last year, can't say thanks, but in large part due to the ongoing COVID-19 pandemic, where we've seen thematic issuance, especially from China. And we've counted that as part of the social theme because we think that it is indeed obviously an important mechanism to alleviate some of the impacts immediately, but it may not be a permanent feature of this market. Hence, we're counting it as part of the overall social theme. In general, the pandemic issuance peaked in February and then started to go down towards the end of the year. And I'll talk a little bit more about that in the next slide. So 2020, green bonds especially are still the largest outright source of capital on a cumulative basis, as well as in 2020. And they had a record third quarter of the year. We've never seen issuance this high. And actually the early indications of this year, 2021, show us that we may expect this trend to continue in terms of breaking also quarterly records in this year, which is obviously fantastic news. I'll show you these scorecards, which you'll also be able to see in the report itself. So green bond market, by far the largest, representing about 65% of the cumulative issuance. We've seen a number of new issuers in this space, including 10 new sovereign issuers for the GSS, overall GSS space, 7 of which issued under the green label, bringing the total of this issuer type to 22 number of issuers. In the sustainability bond market, we saw a 2.3 time increase to the preceding year, which is fantastic news. In this space as well, 3 sovereign issuers issuing labeled bonds. And I wanted to actually flag to you that we talk about sovereigns a lot as a mechanism for potentially transforming the overall bond market when it comes to green, social, and sustainability funding because of their large influence in this space. And we published some dedicated analysis on sovereign bonds at the start of this year, which you'll be able to find on the Climate Bonds website as well. So I'd highly encourage you to look at that survey where we go much deeper into the dynamics of sovereign issuance. But going back to the sustainability bond market, beyond the sovereigns, this is also the theme out of these 3 themes that has on average the largest instruments. And this is in some part thanks to some of the larger deals coming from corporates. You may have heard of the largest sustainability bond to date, which actually comes from the Google parent company Alphabet, which was also issued in 2020. And this is sort of interesting because it's in quite stark contrast to the green bond market, which is still sort of demarcated by the largest issuer, Fannie Mae, the mortgage lending institution from the US, who issues in small deals and small tranches, and therefore pushes down the average deal size for the green space, but also helps to boost the overall market size, and obviously is a huge deal in terms of bringing forward these developments in the US, which I'll touch on in a moment as well. And we'll be publishing dedicated analysis on the North American green, social, and sustainability bond markets later in this year. For social bonds, you'll see there's a really high number of issuers in this space. And again, this is in part due to the emergence of the pandemic label last year. Lots of these come from China, but we've also seen examples in Europe, Nordic Investment Bank, some other North European issuers and the likes coming into this space. We think that this trend is going to continue in the sense of social bonds are here to stay. There are more investor mandates that are either incorporating these into a broader sustainability mandate, and even some that are looking at specific social bond funds, for example. Then a little bit about the spotlight theme. So obviously the shapes and sizes of the market don't exist in a vacuum. They're very much driven by a number of key themes in this space. And we wanted to highlight some of these in the report. What is really significant for 2021 and beyond, and what we're already seeing as key drivers in this space. Transition. If you're at all familiar with this space, you'll have heard this as an almost buzzword, but it really is what needs to happen. We've talked a lot as Climate Bonds Initiative about entity level financing, and this has become apparent also in the broader space with other organizations like ICMA and many others working in this space to understand what it takes to assess entire entities and their strategies in terms of decarbonization and broader transitions to a more resilient model of operation. This has already given rise to new instruments and new labels, most predominantly potentially the transition labeled use of proceeds bonds, which we haven't seen that many yet. We talk a little bit about the numbers also in the report, but perhaps more importantly in terms of the speed of growth, the sustainability linked bond model, which is tied to entity level KPIs. Related to this as well in terms of transitioning, but in this moment, potentially the hottest topic, as Sean as well alluded to in the beginning, the recovery from this very much still ongoing pandemic, which is by far not yet over, as Sean mentioned. But we have seen some good indications of certain countries and even regions and local governments linking some of their public spending to green outcomes, which has, if done right, the potential of crowding in investment because it can introduce new projects that are green into the real economy. And obviously there are lots of organizations tracking the spending. We've quoted some of their statistics in the report, the numbers are not quite there yet in terms of what we would like to see, which is 100% of the recovery spending being tied to green and resilient and climate-friendly outcomes. It can be something like 30% or even less in a number of countries, but this is still happening. So we would just encourage the conversation around this to continue to make sure that the sort of bailing out of or support of traditionally highly emissions intensive industries doesn't overtake the green recovery spending. And then perhaps the biggest, most momentous shift, which Sean also mentioned in the beginning, a small part of this is the delegated act that was published last week. But the general leadership of the European Union actually goes beyond the EU, we think. There are a number of budgetary and policy mechanisms that have been introduced by the EU over the last 5 years or so, including the taxonomy now in a delegated act form, as well as a number of different types of disclosure regulation and so on and so forth. We think that this has the potential to contribute to standardizing of data, both in terms of what is required of issuers, but what investors need to be able to meet their disclosure requirements going forward, which is a big thing because this has been quoted time and time again, and we've found this in our research and conversations with market participants over and over again, as well as a key barrier to scaling up this market. We need a set of common definitions to be able to build the scale that we really now so urgently need. Related to that, there is an exercise that needs to also be done that's sort of already underway, which is to harmonize these definitions, taking into account that they can't be exactly uniform for the entire world, but there are ways in which we can make sure that they interact with one another in a productive way. For example, harmonizing the China Green Project Catalog with the taxonomy is something that is already being worked on under the International Platform for Sustainable Finance umbrella. And I'm sure the panel will talk about this more in a moment, so I won't go into more depth in this, but just to leave you with the EU and its role as a seller. We'll hear firsthand from Bernhard in a moment, which will be very interesting. And also the European Central Bank through its asset purchase program and its emergency purchase program for the pandemic as a buyer of green labeled bonds, which they famously said they own 20% of all of them already, and making the newer instruments eligible for these programs, including sustainability linked bonds. And finally, a little bit more about the outlook. I mentioned this already, a new climate triple axis, potentially China, EU, but also the US. Sean mentioned the Biden summit that took place last week. We've been very pleased to see the US re-enter the world stage in this regard, and it remains to be seen what exactly the outcomes are, but hope that this has the potential to further catalyze a sort of real global landscape and not so Eurocentric going forward. The taxonomy and definition development and harmonization is a key part of this. We also would like to see and expect to see more countries join what we call the Sovereign GSS Bond Club, so the Sovereign Green Social and Sustainability Bond Club, to expand the 22 strong membership. And there are many, many countries that have already committed to doing so. So this is one of the things in which, or one of the ways in which we can reach the 400 billion or more of green issuance, let alone much more when we count the other themes into these numbers as well. Transition, again, very, very key. And it relates, we think, quite closely to a better understanding of climate risk, which can stimulate demand. Disclosure requirements for investors, stress tests for banks, and a number of other mechanisms can help foster these changes when understanding that really the risk is here already and needs to be addressed right away. And finally, we also saw last year and already this year, sustainability being increasingly embedded into investment decisions in a way that means there have been record inflows into sustainability themed funds, for example. But the work is still underway to understand what exactly those definitions should be. And the EU framework is one way to address this, to make it sort of abundantly clear what it means when we're saying we're investing in a sustainable fund. These are all very positive mechanisms and aspects of the outlook. And I think we're going to see another extraordinary year for this space. I thank you for listening, and I'm going to hand back over to Sean so we can get to the actual discussion. Thank you very much.
Thank you very much, Krista, for that illuminating report. Can I ask the panelists to turn the cameras on and join us as we discuss it? Interesting point about sovereigns that Krista made. 55% of the global, roughly $100 trillion bond market are sovereign green bonds. And yet the total issuance is a tiny fraction of that. So as you can see, there's only upward we can go in this area. And we're hoping we'll see substantial upward going forward. I'm going to ask to kick us off, Rupert Cadbury from State Street Global Advisors. He's the fixed income portfolio strategist, to make a few remarks, and then we'll hear from the other panelists one by one. Rupert, your reactions, your reflections about the state of the market, where we're going, what's actually happening?
Good afternoon or good morning, some of you, and thank you very much, Sean, for having me on the panel today. What we see at State Street Global Advisors, we're largely an indexing house. We've got over 500 billion in fixed income assets under management. But what we see is investors really seeking to incorporate ESG, but specifically recognizing climate risks, and the key focus of that today, looking at green bonds. Fixed income market has an advantage essentially over equity market in that. Now, investors, they want to essentially green up their exposure, given the climate risks, as well as the opportunity it poses. And what we see to meet the goals of the Paris Agreement, there's huge trillions, 3.5 trillion is needed really to help meet the goals of the Paris Agreement annually. And investors recognize that they have a pivotal role in that. Now, the big challenge we see when we're discussing with investors across the world, APAC, EMEA, US, is they want to green up, but essentially the green bond market still remains relatively small, particularly outside of the Euro investment grade market. Also, they cannot ignore their risk return objectives. So they want to try and green up whilst not ignoring the ESG and the risk impacts. Now, the green bond opportunity set, we're seeing it's growing, but demand, we're seeing, even though green bonds have been around for a while, over 10 years, demand still continues really to outstrip supply. So we're working with investors who want to incorporate a climate thematic approach. And then really there are two things they need to sort of consider to do that. They need to look at a way of reducing their carbon emissions and fossil fuel related exposure, but more importantly, have a way of examining and identifying companies that are aligned or making progress in that transition. And for many of the investors we speak to today, green bonds are an obvious way for a company or sovereign issuer to signal that they are doing just that. So they are a key building block in any sort of climate thematic investment solution. And the frameworks that we're developing look at green bonds, of course, but for some of the other elements, we're looking at things like carbon intensity, fossil fuel reserves and brown revenues, and some forward-looking scores in terms of companies or issuers on their state of position on climate change, if they have greenhouse gas emission reduction plans and the steps they've taken to try and meet those. But when it comes specifically to green bonds, where they exist in the universe, we're typically looking to significantly scale up the exposure to those, typically by a factor of 2.5 to 3.5 times that of their baseline index. Because bear in mind, many of these institutional investors are index tied to an extent. So for something like your Bloomberg Euro Corporate Index, green bond exposure maybe just 3%. When we scaled it up in a more climate thematic investment solution, you're looking at over 12%, potentially even higher when you're incorporating also climate aligned issuers as well. So what these strategies are seeking to do really is increase that exposure to green bonds, but still be mindful of those duration spread and yield to worst sort of objectives that these institutional investors have, while meeting those climate objectives and still keeping that tracking error very close to that of the standard baseline benchmarks. Sean, I think you're still on mute.
The most common term in the English language. You're still on mute. Good overview, Rupert. Thank you so much. Interesting what you're saying about demand outstripping supply, which I think is a feature we're hearing in all geographies, whether it be Chile or whether it be Malaysia at the moment. So I guess that's the theme of the time. Ingo, you represent one of Germany's most important and largest investors. Do you have the same echo? And what are you seeing in terms of appetite in Europe at the moment for these kind of things and where the market's going?
Actually, it's very similar to the global view. I guess in Europe we have one particular issue, that's regulation. At the forefront, the European regulation last week, we saw new steps that are encouraging, especially for the real estate market, for example, and the adoption of the European Union taxonomy and the climate delegated acts that really help to drive the green bond growth further. At DECA, we have basically two angles to the issue. The first one would be DECA Bank has a DCM department, and I work very closely with my colleagues over there. They are mainly the underwriter of green, social, and sustainability bonds, specialized on financials and SSAs for Germany and core Europe. And we try to get these information into our investment processes at DECA Investments. So I'm from the investment side. And our institutional clients have a huge demand towards climate bonds, green bonds. More and more social bonds are on the agenda. But for us, we face some challenges, actually. The first one would be still the data issue. And that's closely related to the acceptance of a second-party opinion, for example. For us, a second-party opinion is necessary to invest into a green bond. Another aspect would be to focus on the do not significant harm issue. We have to make sure that we don't have any negative principal adverse impact in our portfolios, and more clients are demanding such a view due to the disclosure regulation we currently saw in Europe. In addition, there is a big question: how strong will regulation push investors towards green bond standards? Is there 100% alignment to the taxonomy? And will there be really a big standard for Europe going forward? Currently, the market is still fragmented, but there is a huge demand and unfortunately only very low supply.
Which is a terrible position to be in the market if you're an issuer, right? I mean, Bernard, you've just heard an investor say there is unfortunately a terrible problem in supply. Of course, you've been responsible for the landmark, the huge entry in 2020, which is the European social bonds with the Shore program. Tell us a bit about this experience and how you managed all of these investors who seem to don't have enough supply, and how it worked for you. Tell us your story.
Thank you very much for having me here today, Sean. I perhaps just one word before I come to your question. I mean, I think we heard from both Rupert and Ingo that, in a sense, green bonds are also seen by investors as an excellent way of being able to do something. And I think it's the same for the issuers. I think it is basically a vehicle for us to transport policy choices that are being made. And in that sense, I think the Shore issuance is obviously, from a financial perspective, extremely important, but it's not the least very important also from the signal that it sets in the sense of solidarity in the face of the crisis. And it is true, obviously, that we have, in a sense, benefited as an issuer quite substantially from the fact that there is indeed still a dearth of these assets in the market and a huge demand. And I think it is obviously very, very interesting to note. Krista didn't mention it in the social part of her presentation, but I mean, Shore was basically, I think, if I have calculated correctly, more than 50% of the overall issuance in the social bond segment in Q4 of 2020. And I think even in a sense, adding such a major supply, in a sense, has still only made a minor dent in a sense on the demand side, because as you will have seen, our the different various issuances have been oversubscribed very heavily. So I think the order books were around 10 times oversubscribed, roughly, a little bit less now, but I think we think this is also natural in a sense as the market kind of settles a bit more. But still, I think this is obviously a very positive situation to find yourself in in as an issuer. I think overall, obviously, this has allowed the EU to step up as an issuer. I mean, it's by far the largest program we've ever done. It has allowed us to do more frequent and bigger issuance, also in different tenors in a broader spectrum of the maturity spectrum. And I think in that sense, it has also been a great opportunity for investors to find the exposure, basically. And in that sense, I think we would like to kind of continue in that vein. So as you know, we have issued already 32 billion this year in Q1, and there's another 13 to 15 billion to come in Q2. I think the program overall is largely going to be completed before the summer or by the summer. I think then, as you know, the EU's remains very much committed to this the ESG space, and as you will already know, even though SURE is a temporary program that has then run its course, now we have also the agreement from the Council, the Member States, to start the implementation of NGEU, so the Next Generation EU rescue package that the Council and the institutions agreed on in December, which we then hope to start implementing basically in the second half of this year. And part of that will be issued in green bonds. So even though then we will move in line of the political priorities from the social immediate addressing the problems of the crisis, moving towards a long-term priority, which for the Commission is very clear in the green space. Thank you.
That particular program, the green program, of course, is estimated to end up being around 225 billion euros in size, which would be a massive, let's call it liquidity injection into the market and going forward. So I'll be interested to get reactions to the EU program, the SURE program, most importantly, and then whether you're looking forward to the green bond program from speakers as we go on. I need to just stress that I forgot to mention Bernard is the head of unit for the budget and performance and policy mainstreaming at the European Commission. And Ingo is the head of sustainability and corporate governance at DECA Investment. Of course, now I have Parosh Bhattacharya, who's the director of strategic risk management group at Public Debt Management Office, Thailand, who is responsible for one of the landmark issuances in an emerging or middle income country, Thailand. Tell us your story. And of course, Parosh, tell us a little bit about the Asian investor demand versus European investor demand you might have seen as well, because people often think this is just a European story.
Yes, thank you for inviting me to join the panel today. And also thank you for including us in your report. Let me just, we issued our first sustainability bond last year, in September last year. We set out to do $3 billion US for the entire fiscal year. We reached that amount last week. But before I talk about the bond, I want to talk about why we are doing it and the rationale behind it all. I think it's a duty for any sovereign or any government to be, take a leading role in this area. And the private sector in Thailand has been issuing green bond long before us. But the government's been committed to the UN SDG goals, Paris Agreement Accord. And we think that to have a financing side from the Ministry of Finance doing a green bond, social bond is important to underscore our commitment to the goals and just do our part really to help address this global issue. We started with the green bond, but as Sean mentioned, and that's why we do the sustainable bond in the end, because for a country like Thailand, we are very prone to severe weather patterns, floods, drought. But if you look at the social side, we have a lot of inequality as well, and the lower income people live in the disaster-prone area, and the more climate change related issues happen, that affects the issue for the low-income group of people as well. And then you have COVID, so that really made the decision for us to go towards sustainability. So when we did our framework, we drafted the use of proceeds. We look at other countries as well, country examples, but we decided on to do something specific to Thailand. You look at our economy, then like I said, the agricultural sector is a big part. and that is prone to climate change issues. So the green projects, we include the usual like electric energy sector, power, water resources, very important to manage drought and floods. But also we wanted to extend to the less allocated areas so far, which is the marine biodiversity, coastal areas, which is an important part for Thailand tourism. We want to move towards sustainable tourism in the future. It's difficult, but we will try. For the social side, obviously a lot of money allocated to COVID relief, healthcare, equal opportunities for all people, like access to education, housing. It's all included in the framework. And the framework, one of the important, difficult thing, I think the challenging things for sovereign to do is, it's not like corporate where it's under one roof. We have 30, 50 different ministries doing different things, and it's important to have a committee that is includes everybody, all the stakeholders get involved. So far, the report has been released on our website for the first chunk of the green and social bond. So for the inaugural bond, the one that's ongoing at the moment, it's the green is for the mass transit electric train in Bangkok. The other part is for, the big part of it is for the social COVID relief. Now we're going through a third wave. So it's going to be probably more spending towards that area. For the issuing bond itself, we heard a lot of, before we decided on the tenors on the bond, we had a lot of concern about liquidity issues. How green bonds are less liquid, and we were a little bit worried about the demand from various type of investors because ASEAN, I think ASEAN funds in general or investors they don't have explicit mandate, probably like in European countries. So they do invest in it, but it's not an explicit mandate. It's sort of sometimes just for a PR stunt or a little nice thing that we've done this, but it's not as explicit in Europe. So what we decided on was in Thailand, we have our benchmark bonds from 5 years all the way to 50 years. And they are something that we commit to investors every year. We don't really change the amount. It's a committed amount too. And we thought that if we just allocate the 15-year bond entirely for the sustainable bond, which is a very important tenor for the Ministry of Finance to raise our funds. I think that shows our commitment towards that we have to keep doing the auctions for this bond, because if we don't do it, then we miss the benchmark, which is a lot of things we promised to the investors. So we've basically sacrificed the entire 15-year tenor to the sustainable bond. And I think that played a big part in getting a lot of different types of investor in for the first auction. And we know that offshore investors don't really invest in Thailand unless it's mostly index-linked investors in our bonds. And because we do the 15-year, I think we sort of clearly indicated that one day we'll be back in this, for example, JP Morgan index, which is so far it's already back in the index. So we had a good response from the offshore investors, around almost 20% from the initially on the inaugural bond. And that we have, pension funds, lifers, banks, and a very diversified group of investors in so far. And the first bond was about 3 times oversubscribed, and the pricing was very tight, lower than the existing 15-year bond at the time. And the latest auction, we had over 4 or 5 times oversubscribed in the bond as well. So as like I said, we already reached the 3 billion mark. We will either start a new branch, the new tenor, or just reopen the original one. So I think we will, go ahead, Sean.
No, fantastic, Baros. That's a really, really interesting story. I especially like the point about picking out the 15-year tenor. And I want to ask Bernard, in your thinking about the issuance program, the tenors and so on, was that a factor? Because the German Finance Ministry has said that was a factor of the tenors they chose, and the French have said the same thing. Did that question about your relationship with broader liquidity and benchmark pricing in the market and where there are gaps come into the thinking at all?
Well, I think it has. If you look at the shore issuances, they are all quite nicely distributed. There's an investor presentation on the website of the Commission that I will. We can circulate a link if that is interesting, where you see basically all the issuances that we have done in the shore program until now. You will see that it basically maps out the entire end. The long end of the yield curve. Obviously, we are not that interested in the short end in this specific program. So yes, I think there was clearly a view here to kind of cover a lot of the different parts of the yield curve. I think for us, very important to keep in mind is that the shore program is still a program that is part of what the Commission traditionally used to do, which is on lending, and that means basically that the proceeds that come from the market are directly passed on, including the rate conditions of the deal, to the member states that actually receive the money. And that means, in a sense, that this is not a kind of diversified funding strategy. So as the Commission is planning for NGU. So from that perspective, there is no short end of the yield curve, and there was perhaps also not kind of, I think there was some thought in there how we kind of mapped out the curve, but I think obviously we are limited in what we can do. And we wanted to also present a mix of interesting conditions and risk profiles to the member states that actually have to pay that back at a later point in time.
Good point. Okay, I appreciate that. Ingo, a question I want to pick up with you from what Parash's comment was talking about was mandated funds versus general funds. This is something, that conversation that goes around the market all the time. Are we being driven by mandated sustainable funds or by general funds? What's your thinking at DECA on this question, and how are you dealing at that within your broader investment mandates?
The main demand for green bonds is by mandate funds, and we have a specific issue, at least in a lot of countries in Europe, that we have specific exclusion criteria when we talk about, for example, specific ESG funds, that by the exclusion criteria, some, for example, companies are excluded due to their very critical business model. And if such a company issues a green bond, maybe let's assume you are a coal utility company heavily relying on coal, and then you issue a green bond, then for most mandate funds, they are not investable, because the parent company is still in this coal business, even if this company finances the transformation with a bond, with a green bond, towards decarbonization or lower coal. And that's a big issue for us in practical terms, to make sure that we really can encourage transformation, because the risk of the parent company is still there. As long as the parent company in the utilities sector, for example, issues a lot of carbon, and this will be reflected on the green bond as well. When we go beyond mandate funds and we go into our broader institutional client business, it's not such a big issue, but then you have the green bonds only as a minor portion, just to add it on to a current portfolio. The interesting part is now that the impact category is coming from European regulation. So we have the classical mandate, ESG mandate with exclusion criteria and a very safety net and dense exclusion criteria net. And then we have the new impact funds. And for the impact funds, you have less exclusion criteria. And this could be a category that can drive green bonds even further.
Interesting. Very interesting thought. Rupert, from your perspective, I know you've got, all sorts of mandated funds within your broad mix. But are you seeing demand from general funds as part of this, as Ingo says, or what's your feeling about this mandated versus general fund demand driver, given the volume of demand that's overall?
Yeah, that's a good question. I think it's more sort of mandated is where we're seeing the specific demand for green bonds. We buy green bonds in our conventional indexing strategies anyway. But where we've got something like the sustainable climate framework, green bonds have a specific focus there. So whilst I mentioned that, companies, if they're flagged for having high carbon intensity emissions or significant fossil fuel reserves or brown revenues from highly damaging and extractive activities, if that entity has issued a green bond, they would be exempt from that, because we see investors that green bonds are a fundamental tool in helping to fund that transition of a company from very polluting to a low carbon economy. So if a company can demonstrate they're taking the steps, and the clearest way they can demonstrate that is by issuing a qualifying green labeled bond, that would qualify for eligibility in a sustainable climate investment framework. So we're looking and we're seeking to encourage, and we're seeking to also develop an engagement program really around those energy sectors in particular, to help encourage green bond issuance. But if they're going to do those issuance, making sure that they're to a credible label. So for us to identify a qualifying green bond, as you know, Sean, but others may not know, we really look to the Climate Bonds Initiative taxonomy for that, because there are varying degrees of standardization in green. And we want to make sure we're using the highest standards of green, and encourage any issuers out there to also look to that standard, because from our investors' standpoint, they want to seek a common global standard. And that's still a major challenge. Climate Bonds Initiative are doing fantastic work and to harmonize that, but that is a challenge for many investors, which could potentially scare them off that. So green bonds are key, but where there are, even if they're invested in damaging extra activities, if they can demonstrate it's a green label, then they would qualify.
Bernard, I don't want to put you on the spot about the green, but as you've raised it, do we have much visibility yet on whether the program will link to a green bond standard that the technical expert group recommended, or there's no taxonomy, or is that still in the mix, still being sorted out? Just tell us what you're able to tell us. I appreciate there are lots of moving parts here.
Yeah, there was also already a question in the chat I couldn't help but noticing. No, I think this is still part of the mix. I think we have a few legal issues in the sense that so I have to be slightly technical. So in Next Generation EU, you know, this huge initiative, we are borrowing 750 billion euros from the market. Most of those funds, I think roughly around 90%, will go into a program that is called the Recovery and Resilience Facility, which is basically the program that then passes money on to the member states that then actually implement national recovery and resilience plans that are approved by the Council. Now, that program was basically approved in legislation in December at a time when the delegated act was not available, and actually even the Council and Parliament, as the co-legislators, decided that actually they explicitly state in the regulation that the delegated acts do not apply, and that means basically that we find ourselves in a slightly difficult situation. Obviously, the member states are always free to apply the delegated acts in their expenditure, but there is no legal basis for us to kind of demand this, and that means that we have tried in the climate in the climate what we count as kind of green and climate relevant in the recovery and resilience plans. We have included elements from the, at that point, tech report, because it wasn't a delegated act yet. So we have included elements of substantive conditions into the climate methodology. And on that basis, we have kind of reintegrated it to a certain extent, but there will be no one-to-one alignment on the taxonomy. And that also means that depending on how you are going, or we are going to kind of table a EU green bond standard, there will be a link with the taxonomy, and that link we are not able to fulfill. So I think that is a long answer to the short question whether we are going to link ourselves straight to that. But we do believe that in substance we will have a lot of alignment. But we will, from a framework perspective, use and have already launched that process, the available current gold standards in the market. So ICMA is what we used for sure, the social bond principles, but ICMA, as you know, also has a green bond standard, or green bond principles basically, and we will come up with a framework aligned on that, in a sense as all the sovereign issuers do currently, you know, and then they kind of have a view of how they might be over time coming towards the EU green bond standard, but we will not be able to do that from our perspective.
Rupert, Is this likely? Do you see any issues in what Bernard's saying here in the European program, or does that sound like a comfortable solution to the challenge that they faced?
I think a comfortable solution. It's about transparency as well, and that's something that's still an industry challenge worldwide. Transparency, particularly in like the use of proceeds to help investors understand, what are the actual positive, impactful outcomes from these green bond issuances, and also being able to sort of standardize that. So when you've got an investor who has multiple portfolios, possibly invested in hundreds, if not thousands of companies, there's a way they can aggregate that information and summarize that to their underlying investor base as well.
I think there's some really critical issues here about in terms of how we take the thing forward. And the key point we're saying is transparency, visibility. And I'd back that too. I'd say we want to know where the money's going. We want to know if it broadly fits what we've got to do. And within that envelope, there's a lot of work to be done to sort out detail in the future. I mean, Parash, with your issuance in Thailand, you actually applied for and successfully received client bond certification for the green components. And then you provided a simple second opinion for the social component, which is all that's available in the market. Did you have any questions from investors about the nature of independent review or comfort? Were there any issues that arose about transparency, or was it smooth sailing with your issuance?
Yeah, we just made sure that we would meet on the standards with a second opinion. So our framework was verified by Sustainalytics. And then the next step was to apply for the climate bond initiative for the green part. So I think that helped stand in terms of transparency. We got a report out quickly, and also actually tomorrow we will be listing in the Luxembourg Stock Exchange for the sustainability bond. So I think it's important. We took it very seriously, and we intended to transparency an issue. That's why in the committee we had 3 or 4 people. We had the private sector as well in help monitoring where the money is going to the right place. So we just made sure that everything was met in the national standard.
Fantastic. And investors, I guess, supported it. We've got a question for Ingo from Phil Moore. One of your fellow German institutional investors said at a recent presentation that retail investors are increasingly prepared to forego a certain amount of yield if they're satisfied with the use of proceeds. Is this your experience? Do you see this as something that might develop to take more country risk, for example, in Africa to support ESG financing? I appreciate your portfolio is more European focused, but tell us about what you think might develop in the retail space and whether you see development, given you've got the DEC bank as well as the investment side. And I say that as someone who's regularly called for green term deposits and green retail products. So I have to disclose my bias here.
Yeah, actually, it's really realistic, and I believe the development goes further in this direction. From our perspective, it's really important to show transparency to our clients as well, to have the right data and to deliver in such a product and high product quality. I believe in general when we go through the next 2 to 3 years, we see many regulatory changes in this regard, and I believe the role of impact and the role of financial markets as a catalytic converter for the real economy is gaining more and more traction, and we believe the impact category from an investor's point of view is the right one. And if you can combine this with a valid capital market strategy from an investor's perspective, we believe it's positive.
I'm just going to jump in here from Climate Bond's behalf that it looks like we've lost Sean Kidney for a moment, so bear with us as he redials. These are the sort of interesting aspects of being a truly global organization. Sean's dialing in from Australia, so we'll give him a moment.
I may add, Ingo, you mentioned that that there are some companies which need to meet certain norms-based screening requirements for green. We see similar preference for that as well. So it's not necessarily that any green labeled bond instrument would qualify for eligibility in an green-focused investment universe. There are certain requirements around like meeting UN Global Compact principles, and we use sorting data and action Sustainalytics and MSCI to help identify those, or controversial weapons, or those that maybe even violate the Swedish Ethical Council. Those are some of the requirements where even if it's a green labeled instrument, if a company violates those, that would still red flag it and unfortunately exclude it from eligibility in a green focused investment portfolio. So just echo your comments on that.
In this regard, I believe it's also the question of the ECB, for example, for Europe as a central bank. What are going investors do? For example, you can hand in green bonds, green assets for the LTRO and get refunding for it, and you are not bound to invest it into green assets again. Basically, you can hand in green assets and can use the proceeds for brown activities. And that's still a big issue going forward, where there's no standard yet for green bonds.
So the standard for green bonds, and apologies for I had a short outage there for a couple of minutes ago. Thanks for surviving without me. The standards for green bonds is an important development. We've seen taxonomy, notwithstanding the challenges that DG Budget has with making the RRF framework work. We've seen Chinese taxonomy, of course, that announcement on the 21st of April from both Europe and China, the coordinated announcement. And then we have regulation in China. We have also ASEAN, the ASEAN Capital Markets Forum of Regulators has promoted green bonds guidelines, which the Thai Securities Commission, amongst others, has adopted. And now we have the ASEAN central banks setting up a taxonomy board to guide regional taxonomy development. Ingo, this is great stuff, isn't it? I mean, we have now guidance coming through. What are the risks here? Do you see a problem with all of these developments of countries moving to provide stronger guidance, regulatory support, standards and so on that we can adopt?
Don't get me wrong. It's the right approach that we get further standard and developed market. But we have also think about data topics, about basically the infrastructure behind these standards. The standards are nice, but when you are not able to follow these standards because of lack of data or technical infrastructure, or maybe in Europe you have regulation that doesn't correspond to each other, and maybe has a wrong interpretation, then it's getting tough. From this perspective, I believe a standard is excellent, but a standard has to become with infrastructure, data, and basically everything that's around.
So there's work to be done to pull all these things together.
I think we are still busy for the next 5 years.
Of course, against that backdrop is we have 10 years to fix climate, to get emissions down by more than 55%. So it's a balancing act. But in essence, it's not perfect now, but at least we have momentum. And boy, do we have momentum. Krista, can I bring you in here to talk about momentum? Where do you think, what's the view of the markets team now about what the growth curve looks like this year, especially given what you've heard tonight from the various participants? What are you forecasting?
Yeah, absolutely. Well, as I said in the presentation, and Bernhard rightfully called me out on not mentioning that the EU shore has already given a huge boost to this market from the social perspective last year and this year. So we definitely think that the sort of S&S labels will continue to flourish now that the big precedents have been set. There are questions around standardization of definitions and ambition and data, the same exact way as there have been and continue to be for green bonds, but I think more so for the social and sustainability themes. I think those will still continue to grow. The other side is the transition agenda, and we've had a number of conversations recently and sort of been closely following the emerging transactions in this space, especially as it relates to finally making the linkage between, and this has been a key criticism of the green bond market, of the activity to the actual entity that is performing the activity. So the sustainability linked bond framework and structure, for example. Again, I'd caveat this with, additional work needs to be done to ensure that it doesn't end up being solely a PR exercise. And there's nothing wrong with sort of being recognized for doing good work, but it does need to fit within the industries, each industry's sort of, there's an echo, sorry. It doesn't need to fit within each industry's decarbonization trajectory or other kind of improvement as it relates to building additional resilience, for example. So I think those are the big chunks where we'll see improvements, and we'll also see market growth this year. I'm not going to venture into a single number just yet, but keep your eyes peeled for the Climate Bonds website for that in due course.
Thank you very much. Folks, we need to, would you believe, wrap up. I think we could talk about this for time. Can I ask for just a final thought from Parosh in Thailand? You've had a successful start. You've had clear ambition to do further. You've had a very strong response. What do you see as the future for both this market and your own activities in the area?
Exactly like you said, this is just a start. It's a successful start, but it's only the start. So for us, we just have to keep doing it, keep issuing. And we already start doing that by, expand to other sectors. We're already talking to the Ministry of Environment to expand to other sectors in the framework. So we'll keep our commitment in issuing. And like you said, I think we all agree that the momentum is already there. I think in terms of investors, all stakeholders, so we can only think that it's going to grow. For us, we already encouraged other private sector and also state-owned enterprise to issue as well. So we expect them to continue to grow. It's a long-term issue, so we have to keep doing it.
Long-term commitment. Ingo.
Long-term commitment.
Thank you, Parosh. Ingo, for you, final thoughts on where you think this is going and where to go next.
We have to make sure that capital markets are still in a leading role to transform the real economy. So to be rather pushy on this topic, and we believe, or I believe, that transformation is key, and transformation has to go hand in hand with investors' return, an acceptable investors' return. And if this is possible, we can clearly make an impact, but we have to act now and have to make sure that we still keep the growth path and be on the right side of the market.
Very important remark. Bernard, you are the elephant in the room and soon to be a bigger elephant with the European Commission issuance. Your thoughts on this market based on your experiences so far?
And I think it's an extremely important market, not just to us, but very much in general. And I think that for the Commission, it has always been very clear that capital markets have a prime role to play here. I've heard also a number of things that we have as regulator, obviously, as in our other hats as regulator. We also need to kind of be mindful about, and I think we are very much aware of that in regular dialogue with all of you actually. In the European space. From an issuance perspective, we are obviously very much looking forward to the rest of the year, and we hope that we are going to be able to make a success also out of the green bond framework that we are going to present in the course of this year, and the issuances that are going to follow. And what I've heard today, that fills me with tremendous confidence. So thank you very much.
I suspect, Rupert, you'll be happy with that news as well. But in terms of prospect issuance and what Parosh is saying as well. But tell me, your thoughts, your reflections after this conversation on the future.
Yeah, absolutely. I think similar to what's been said on the panel here and by Ingo, well-functioning capital markets, I think, are going to be probably the most powerful tool we have for turning this vision of a resilient, low-carbon economy and meeting the goals of the Paris Agreement into reality. And really, there are three key building blocks needed for this, in my view. We need effective capital market instruments that package this risk return of climate or green focused projects, and green bonds are the answer to that. We need credible and harmonized standards of what defines green instruments, and CBI, as I mentioned before, is doing tremendous work in helping to do that globally. And then the asset allocation strategies that allow really investors to take action now in constructing portfolios aligned and facilitating the transition to a low carbon economy. And the sustainable climate framework that we've developed does just that. And I'd urge you all to keep an eye out. We've got something very, very exciting, hopefully coming out, not just on the horizon now, imminently, maybe as early as this week, so more to come.
Well, that is a tease to finish up. So thank you, Rupert. Krista, a last word.
Yes, I actually just wanted to echo everybody, but especially Parash. There's no way to overstate the importance of sovereign issuance, and they are the issuer group with the ultimate power to transform this market and introduce the well-functioning aspects that Rupert also alluded to in terms of depth and liquidity. There's so many commitments already lined up, and obviously also the supranational side and the regional issuance will help with this. So we're quite optimistic for this year. Thank you.
You've heard a lot, everyone, about sustainable bonds with an emphasis on sovereigns and subnational and so on, but the broader market. If you want to find out more about pricing, we didn't cover that. There's a whole report on our website about pricing. Clearly, this is just a market. It's an exciting market. It's a signaling market. It's a way of bringing together investors who are concerned about shifting their portfolios to a more sustainable basis to reflect the interests of their customers, their stakeholders, and organizations that are doing that. That's what marketing is about, and it's working that way. But of course, the hard work in the long run will be the real economy. It'll be the measures the European Commission takes at a regulatory level around energy efficiency or energy that are really where the hard work needs to be done. We'll see some of that in the Resilience and Recovery Fund application coming forward. We'll, of course, see that in the Thai government's program to implement the spending commitments in the green and social bond they've done, and with bond issuers around the world. But as a market that is showing that capital will invest if we start doing what needs to be done to change this planet to become more sustainable, this is it. This is proof of concept. And that's what we need to continue to pursue going forward. We have a lot of work to do, to dramatically cut global emissions in 10 years, at minimum, commensurate with the commitments of so many countries at the Biden Climate Summit last week, including, I'm very proud to say, as a citizen of the European Union, the European Commission. Well, we have also a lot to celebrate from what's happened in the last few years. In the middle of a really tough year, this market grew. It was an indicator of energy shifting to building back better, in the words of Kristalina Georgieva. And that's what we have to do as we come out of this crisis. This webinar will be recorded. It has been recorded, I should say. You can listen to it on YouTube or on the Climate Bonds website. And of course, we will attempt to answer the questions that we haven't been able to answer typing away or in the course of the panel afterwards. Thank you so much, everyone, for joining us. But above all, I have to say thank you to Bernard, to Ingo, to Rupert, to Parash, to Krista for having made this such a fabulous webinar. Thank you, everyone, and good luck creating a future that you'll be proud that your children can live in. Children can live in. Good night, good night, good morning, good day.
Thank you.